Good morning, you're watching Market Cafe with me, Shreyansi Singh and Snehi Shah, and over the next 1 hour, we'll take you through news and updates from within the country as well as across the globe, tell you which stocks you should keep on your radar, also tell you what brokerages are saying this morning as well. There's a lot to cover on the show, so first things first, let's take a look at what the international handover is looking like. Snehi, what does it look like to you?
Well, Shansi, not so great, but yet again the drop is not something big to worry about. But yes, Wall Street has declined. All three indices have declined when you look at Wall Street's intraday session yesterday. And stock futures have fallen as Wall Street weighed the latest earnings results and looked ahead to the Fed Reserve's favored inflation gauge. Now, the US GDP, which is another key metric that we received yesterday, increased at an annualized rate of 3.2%, largely propelled by healthy consumer spending. And we'll take you through more about the US GDP as we move on with the show as well. But when you look at individual indices, Dow was down less than 0.1%, a 23-point drop coming in for the Dow. Not much of a drop and not much of a worry over there. S&P 500 also down 0.2%. Nasdaq, however, is down 0.5%. So that is the indices that is lagging among all of the three indices on Wall Street. Now, Wall Street anxiously awaits Thursday's personal consumer expenditures reading for the month of January. Economists are bracing for a 0.3% monthly gain and a 2.4% year-over-year gain move as well. A higher than expected print could dent equities and signal that recent hot consumer price index and producer price index releases were on trend. Now, Thursday's session caps off February trading and another positive month for the three major averages despite a string of declines, raising questions around the sustainability of the AI-driven rally. Remember what Nvidia and Nasdaq have done in just the last week, and the Nasdaq is leading the pack with a 5.2% gain on the back of Nvidia's rally that we saw. The S&P 500 has jumped 4.6%. Dow has added 2.1% for the entire month of February. Now, this would mark the Dow's first 4-month winning streak since May 2021. The back end of earnings season continues Thursday with results from Best Buy, Hewlett-Packard, and Bath & Body Works. And other key economic figures are due out as well, including personal income data for January, Chicago Purchasing Managers Index data for Feb, and the pending home sales data for January as well. The New York Federal Reserve Bank President and CEO John Williams is also slated to moderate a discussion in the evening. So we'll be watching out for all the commentary that's coming in, and all the major averages are headed for yet another winning month, like I mentioned earlier. Now, well, today is an anomaly. It is leap year day, and we're also spotting an anomaly on Dow because even more notable is Dow's streak. Right now, if it closes the last session in February in the positive territory, the 30 stock index would clinch its 4th straight winning month for the first time since a streak ended in May 2021. Leap year coming one time in 4 years. Dow's rally looks like it's going to extend for the first time in 3 years. The index is currently up 2.1% on a month-to-date basis. So, well, that's the handover that's largely coming in from the US markets. European markets on the other side look rather mixed. DAX is up 0.2%, FTSE was down 0.8%, so that's a pressure point coming in on the European indices. CAC rather flat, but in the green, and stock 600 also on an overall basis down almost 0.3%. So, well, mixed handover coming in from the US markets and the European markets. Not much to worry about, but yes, 0.5% drop coming in on Nasdaq. But with that, Shreyansi, take us through what's happening in the world of oil.
Absolutely, and there's mixed pricing action when you look at oil. Now, crude oil futures were mixed as US crude inventories rose while OPEC Plus is considering extending its production cuts into the second quarter. So when you look at WTI, that dropped about 0.4%, settled around that $78 a barrel mark. And when you look at Brent as well, that gained just 3 cents, settled around that $83 a barrel mark. US commercial crude stocks rose by 4.2 million barrels last week. According to the EIA, inventories have been rising in the US as the rate at which refineries process crude into finished products has declined in the recent weeks. Now, US crude and the global benchmark are poised for a gain of 6.3% for the month. First month futures contracts are trading at a premium to later months. Now, a premium for immediate over later delivery is typically a sign of a tightening crude market. So that's largely what we're seeing with crude. Now, of course, crude prices have also found support this month from the ongoing conflict in the Middle East as well. And OPEC Plus is considering extending its voluntary production cuts into the second quarter, according to reports. So that's also something that the market is going to be looking at. But when you look at gold prices as well, gold ticked up as traders trapped in for key economic data and comments from US central bank officials on the timeline of interest rate cuts. Lower interest rates do raise the opportunity cost of holding gold, so that's something that is key to note. Now, Bitcoin also continued its surge, shooting above 63,000 for the first time since November 2021, and that's an important move that we also saw when it comes to Bitcoin as well.
Well, we'll bring you more on Bitcoin's move later in the show as well, but let's take a look at all the important cues that you need to be watching out for in today's trading session from India as well as globally. A whole host of important data coming in from India today. We'll be getting the GDP data, as well as, because today is Thursday, we have the weekly Nifty expiry last Thursday of the month, which means it's the monthly expiry for Nifty as well as Nifty Bank. And looking at data globally, then from the US, we have initial jobless claims. Let's shift focus back home and talk about some corporate action. Then the board of PFC will be meeting to mull fundraising plans today, so that counter will be in focus. Today is the last day to buy Jupiter wagons to be eligible for their dividend, and 2 companies will be opening their share buyback today. Bajaj Auto, remember this is a big buyback coming in, and Zydus Life buyback. Both of these buybacks will be opening today. Let's take a look at what's buzzing in the primary markets, and Mukka Proteins IPO will be opening for subscription today. On the other hand, you have 2 IPOs that will be closing for subscription. Today is the last day to subscribe to Platinum Industries as well as the Exicom Teleservices IPO. Lock-in period is ending for recently listed Nova Agritech, 6% equity coming out of lock-in over there as well. And when we look at other events, today is the last day to update your KYC for your FASTag, so remember to do that if you haven't done so already. Fed's Bostic will be speaking at a banking outlook conference, and while the very important MSCI index reading will be taking place after market hours today, so well, watch out for all of these cues in today's trading session.
Absolutely, and let's kickstart our coverage with the biggest talking point this morning then. US GDP increased at an annualized rate of 3.2%, largely propelled by healthy consumer spending. Now, the expansion in the nation's gross domestic product, the economy's total output of goods and services slipped from red-hot 4.9% from July through September. Growth in the United States has now topped 2% for 6 straight quarters, defying fears that high interest rates would tip the world's largest economy into a recession.
Well, meanwhile, important commentary coming in from the Fed Reserve officials as they reiterate that there is still work to do on inflation to reach that 2% inflation target that the Fed has set. Now, Boston Fed President Susan Collins once again said that she believes the rate cuts are likely to happen later this year. Meanwhile, the Fed Reserve President Raphael Bostic said he is comfortable being patient in policy rate cuts as much work is to do for inflation. On the other hand, the New York Fed Reserve President John Williams does not comment on outlook of interest rates but flagged 2-sided risks to inflation forecast.
Absolutely, and shifting focus then, let's delve a little bit deeper into the move that Bitcoin has seen. Bitcoin has hit above $60,000 for the first time in more than 2 years. It has been fueled by surge of capital into new US spot Bitcoin exchange traded products. Remember, this is the largest monthly gain since December 2020. Traders have poured into Bitcoin ahead of April's halving event and June's Fed interest rate cuts.
Well, shifting focus to some global earnings then, business software maker Salesforce for Q4 results surpassed estimates, but the company has issued a lighter revenue forecast for the new fiscal year. Salesforce downbeat forecast signals a likely slowdown in cloud and tech spending as clients grapple with high interest rates and rising inflation, compelling them to keep a lid on costs. The company sees revenue between $37.7 to $38 billion for the full year 2025. Meanwhile, the world's leading premium entertainment producer Paramount Global has hit 67.5 million subscribers worldwide at the end of its 4th quarter. The company's Q4 earning has beat by $0.05 million. Meanwhile, revenue has fallen short of estimates.
And tech giant Apple has announced that it will disclose more about its plans to put generative AI to use later this year at the company's annual shareholder meeting. CEO Tim Cook said that the company sees incredible breakthrough potential for generative AI and that it will unlock transformative opportunities for users when it comes to productivity, problem solving, among others.
Well, the broader trend of downsizing in the West unfortunately continues. Electronic Arts, or popularly known as EA, will cut 5% or roughly 670 jobs of its workforce. The move comes in as a part of a plan that includes reducing office space and ending work on some video games. Meanwhile, dating app Bumble has also announced plans to lay off about 350 employees as a part of the restructuring plan. The company said the layoffs will help drive stronger operating leverage and align its operating model with future strategic priorities. Well, the Indian government is set to release GDP data for the last quarter of 2023, which is expected to come in at 6.9%. This shows a lag in consumption growth compared to quarter 3 of 2023. My colleague Anisha Jain is joining us with more details about it. Anisha, good morning. Take it away.
Well, yes, we are waiting back for the Q4 GDP, and most likely there will be a bit of a slowdown as far as the headline GDP number is concerned. The street is expecting anywhere between 6.7 to 6.9 kind of number. Yes, on Q3 this number had come closer to 7.6%, so there will be a bit of a slowdown as compared to the last quarter. But if you look at it on a year-on-year basis, last year this time around we had seen a growth of 4.5%, so at least better than that. In terms of the reasons why we are expecting a bit of a slowdown, well, the state-led capex, which had been pushing the investments higher and supporting the GDP growth, is expected to slow down in the quarter gone by, and that's the reason we are expecting a bit of a slowdown there. And secondly, if you look at the other internals as well, the basic utility sectors, construction and public spending, these are the segments which might have slowed down a bit. What has managed to see a robust performance is clearly agriculture, so good growth continues there. We are also expecting double-digit growth to happen in the manufacturing sector and a steady performance to come by from the financial services segment, and as a whole this would mean that there is a growth of almost 6.5 to 7% broadly speaking as far as the GDP estimates is concerned. Domestically speaking, the demand has been good, but a lot of focus will also be whether the export demand is coming up or not, because that was something that had come down. In fact, contribution of net exports to GDP was a bit of a drag in the last few readings. Let's see whether that continues or not, but overall there is going to be a bit of a slowdown from around 7.6% growth rate that we saw in Q3. It's expected to come down to 6.7, 6.8, but let's see what we deliver.
Well, thanks Anisha. Time for a quick break then. When we come back, we'll take stock of how the Asian markets are faring.
Hi there, welcome back. You're still watching Market Cafe on ET. Now let's take a look at how the Asian markets have opened up this morning. Asia Pacific stocks have largely fallen as investors await US personal consumption expenditure and price index data for clues on the Fed Reserve's interest rate path. Now, the US Personal Consumption Expenditures Price Index, the Fed's preferred inflation gauge, is due later in the day, while China's Manufacturing Purchasing Managers Index, or PMI, reading is scheduled to be released tomorrow. On the back of that, Shanghai, in fact, happens to be the only index as of now that's in the green when you look at the Asian markets, up 0.7%, good gains coming in for Shanghai. Let's focus and talk about what Hang Seng is doing, because Hong Kong on Wednesday said that it would do away with property curbs in an effort to buoy its real estate sector and forecast economic growth in a range of 2.5% to 3.5% for 2024. On the back of that, surprisingly, Hang Seng has also managed to shift to the green, up just 0.2%, but yes, in the green nonetheless. Let's take a look at what Nikkei is doing. Nikkei fell 0.7% at open, and Japan's manufacturing activity has contracted more than expected in January versus the month before that. Japan's manufacturing output declined 7.5% in Jan versus December. This is according to official data, and the reading was slightly below a Reuters poll forecast of a 7.3% drop. Separately, data showed Japan's retail sales rose 2.3% for a year-on-year basis in Jan, which is largely in line with the Reuters estimates. On the back of that, Nikkei down a solid 0.5%. So we'll see what happens to Nikkei during the course of the day. What's key to remember is Nikkei had hit a record high earlier in the week. Let's also talk about what Kospi is doing. Opened with a downtick of 0.8%. Right there, not doing much, a 0.5% downtick coming in for Kospi as well. Lastly, let's take a look at what ASX 200 is up to. It fell 0.2 on open, and well, it's right there. Rather flat, not doing much, but in the red nonetheless. Let's focus and talk about the bloodbath that was the Lal Street yesterday, and we managed to close at 21,950 thereabouts. Implied open at 21,964, absolutely flat, well, not penciled in for the market, at least during open. So Shayansi, we'll see how this pans out for our markets this morning.
Absolutely strong cues coming in from the Asian markets.
Hi there, welcome back. Thanks so much for staying on with us on Market Cafe. You're watching ET Now. Now, while in big news yesterday, SEBI has directed AMFI to protect the interest of investors in light of the froth that is seen to be building up in the small cap and the mid cap segment. My colleague Anurag Joshi is here with more details on this. Anurag, good morning. What are you picking up?
The surge of inflows in small and mid-cap funds has caught the attention of market regulator Securities and Exchange Board of India, which has now asked Association of Mutual Funds in India to direct the trustees of mutual funds to put in place a policy that will protect investor interest, and this will need to address steps that AMCs and fund managers need to take to protect the investors, and also issues linked to moderating inflows and also portfolio rebalancing. And also the measures that the mutual funds need to put in place will need to address in the investors that may suffer because of a surge in redemptions due to the first mover advantage from the first redeeming investors. And such a policy, AMFI said in a circular to mutual funds, needs to be put in place in the next 21 days.
All right, thanks Anurag. But while you're with us, there's another news flow that we should address. Byju's faces NCLT order to consider extending rights issue after petition by 4 investors. Funds from the $200 million equity rights sale will be held in a separate account until the court's decision. So tell us a little more about this as well.
Yeah, so Byju's, which is due to close a $200 million rights sale of shares, has been asked by the National Company Law Tribunal to consider extending the equity sale. Now, NCLT has passed an interim order on a matter which, on a petition which was brought before it by 4 key shareholders, and Sofina Prozes, Peak 15 are among those shareholders that had filed a petition before NCLT on grounds of operation and mismanagement of the company. Now, 2 key observations which the NCLT has made is that the money from the rights sale cannot be used and needs to be deposited in a separate account until the court disposes the matter fully. And secondly, the shares will be issued under rights after the company raises the authorized capital, and there are 2 weeks given to the authorities to file a reply in the matter. Now the next hearing of the case is on April 4. Now these 4 shareholders have had approached NCLT last week, and they are basically asking the NCLT to reconstitute the board and remove the current CEO Byju Ravindran, calling him unfit to run the company.
Thanks for those details, Anurag. Let's move on to another ET Now exclusive. And Reliance Retail and Dublin-based fashion retailer Primark are mulling a partnership to expand their business to the Indian market. Exciting news for all fashion lovers, including me. So my colleague Aishwarya Patil is bringing us more details on this. Aishwarya, take it away.
Well, we've learned from our sources that Reliance Retail has been in talks with the European brand Primark, which is a fashion, home as well as beauty retailer in that particular region. The 2 parties, Reliance Retail as well as Primark, have held discussions to bring the Irish brand's franchise network to India, and the talks between the 2 parties are currently just in the initial stages. The contours of the deal are still unclear and yet to be worked out between Reliance Retail as well as Primark. To give you a little bit of context, Primark is a fashion retailer headquartered in Dublin, Ireland. They have a network of over 400 stores across 16 countries, including Europe, US, as well as Hungary will also be one of their markets soon. Primark aims to reach 530 stores by 2026 in newer as well as existing market, is what it says on its website. Upon reaching out to Reliance Retail as well as Primark, Reliance, however, did not respond to our query, but Primark says as a growing international business, we are always open to new opportunities. However, at this point, they would not like to comment on where they would like to expand next. So here's what we've heard from the two parties. And going forward, if Primark does come to India under the Reliance Retail hood, it would mean that it will be a step up for the brand in terms of their play in the value segment going forward.
Right, thanks Aishwarya. So that's about the Reliance Retail and Primark partnership. But moving on then, heading across to India's biggest mutual fund symposium, which is underway, that is the 10th edition of Aditya Birla Sun Life AMC's Voyage. The event is being attended by over 2,000 MF distributors across India. Nikunj Dalmia caught up with Mahesh Patil, CIO, ABSL AMC. He shares his views on India, the growth triggers, sectors he's bullish on. Take a look.
If you really believe that Bharat is going to be the third largest economy in the last 7 years, right, and the GDP is going to grow at, say, 7% plus, I think then you will see a lot of opportunities emerging. I think corporate India growth we have seen, which has been very strong in the last 2 years, I think will continue to grow at a double-digit rate, right? And if that is the case, then markets, while they might consolidate a bit in the near term because of the last huge outperformance, but I think you will still make the long-term returns what the markets have given, right? In the last 30 years or 20 years, if you look at markets have given around 13% compounded, I think which is a great return which one can expect. And I think there will be some challenges. We are entering into a period where US economy, right, globally, you could see some slowdown. And to that extent, there could be some hiccups. But clearly for investors or who are taking a longer term view, I think this is an exciting time to be in here, right? I see that for the first time, a lot of fundamentals are falling in place, right? We have, for the GDP, investments, okay, which has kind of not really fired in the last 10 years. We are seeing that leg now starting to do well, okay, which will continue to sustain our growth. Most importantly, I think India's macroeconomic stability has really been significant improvement over there, right? For a developing country, I think that's most important. Whether you look at our currency, right? The volatility in our currency in the last, 2-3 years has been the lowest, one of the top lowest decile compared to either a developed market or the the emerging market currencies. We have seen that interest rates, right, have been fairly stable. So I think that macroeconomic stability would ensure that India's risk premium, which is there, okay, needs to come down. So that will mean that India will continue to remain expensive. I think you're not going to get cheap. I think people always complain that India is expensive compared to other emerging markets. I think that premium will continue to be there. And I think that's investors, if, as I said, if the GDP grows from here, corporate earnings grow, I think you will see returns, reasonable returns from here is what we should expect.
So, if last 3 years have been great, if one looks at the next 5 years, next 10 years, do you think equity returns will be in line with the historical averages, which is anywhere between 13 to 15%? If the starting point is, let's say, today, do you think future returns would be in line with long-term averages for next 5 to 10 years? You may get 1 good year, 2 bad years, 3 good years, 4 bad years, but in general, 5 to 10 years, will the averages of long-term be maintained?
Yeah, I would say, see, if you just go back and see, right, while last 2-3 years has been fantastic, but we went through a pain period, right, even in terms of economy, right, from 2013 to 2018-19, right, where the earnings growth trajectory was much lower than the long-term trend, right? Our long-term trend of earnings growth has been slightly higher than the nominal GDP growth, which is, as you know, and we were growing at around, say, 5% or so. I think this is the last post-COVID where we've seen that acceleration, and there's been a big transformation which has happened. We have seen the overall productivity, the ROEs of the companies has gone up. I think the whole digital transformation also what we have seen, I think India has really handled that very well. And that also places in a better position in terms of globally the change what we are seeing. And also the world, the way the world is reimagining, right? India has now arrived at the center stage. India is likely to be a supplier to the world in a larger sense. So that's an opportunity which was not there earlier. And that puts you in a different growth trajectory going forward. So I would say that if you look at the broader market, right? There are pockets of over exuberance in the market which are there. But if you look at Nifty for that matter, right? So Nifty, while it has done well in the last 2 years, its earnings growth has also been in line with the returns what Nifty has given, right? So the market is kind of fairly valued or slightly above the long-term average. So in that context, I think returns, should track earnings growth, right, is what one would expect. And earnings growth will broadly track your nominal GDP growth, is what I feel. So you're right, I think you can expect the long-term trajectory of earnings returns and market returns is what investors can expect over the next, say, 5 years. I mean, there'll be ups and downs. I mean, after such a large outperformance, there'll be a period. I mean, Nifty, we were discussing the last show, right? In the last 8 years, the market has not given negative returns. I mean, this has been the longest streak what we have seen. It can still continue, but I think we should look beyond that and take a view for the next 5 years. I think that looks still good even from here.
So, Mahesh, 5 years out, give us 3 themes. Where are you reasonably confident of earnings growth? And where are you confident of earnings growth and P expansion?
Right. So I think there are actually, for the first time, actually, if you look at, we are seeing many sectors doing well, right? Compared to what pre-COVID, okay, there was only a few sectors which are doing well. Now, a lot of sectors are doing well. So the one big theme is, as I said earlier, and Harish also mentioned, is the investment theme, the capex, right? So we have seen now the investment cycle slowly starting to pick up. And I think with the focus of, if you really want to really transform and get a GDP growth beyond, say, 6.5%, I think investments needs to contribute.
Hi there, welcome back. Thanks so much for staying tuned with us on Market Cafe. This is ET Now. Well, IndusInd Bank is going to be a stock that will be in focus on the back of its management meet. Now, Macquarie has come out with a brokerage note where they have maintained an outperformance stance with a price target of 900 rupees per share. So my colleague Gaurav is here to break down Macquarie's note for us. So Gaurav, good morning. Take it away.
Yeah, good morning. So first, let's talk about Macquarie, because Macquarie met with the management of IndusInd Bank, and according to the management, they believe that the liquidity in the system is going to stay tightened even in the next in the near term, we could say, and they are expecting this to ease further once the rate cuts are in, and that is again expected somewhere in H2 FY25. Yeah. So rate cuts will also help the bank to reduce the gap between loan growth and the deposit growth, according to the management. But if you look at the sectoral outlook from the management of IndusInd Bank, they believe that they are seeing strong growth in the demand such as from the segments such as vehicle financing and microfinancing. They are also gaining market share in the segments such as LCV financing, car loans, microfinance and credit cards. But they are reiterating their focus on the credit growth, limiting their credit growth from credit card, because they want to limit the unsecured segment in the loan book. Lastly, if you look at the overall outlook from the management, they are expecting loan portfolio to grow somewhere 1.5 times higher than the industry average. They are expecting slippages to come down to a normalized level. And lastly, if we talk about the contingent buffer, which was actually a concern in 3Q FY24's result, so bank is now expecting to increase their contingent buffer to strengthen their asset quality. And on back of this, we also saw Macquarie has maintained their outperform rating and a target price of 1900 rupees for the bank. They have also maintained bank as one of their top picks. And lastly, if we talk about the valuation also, at 1.6 times price to book value, Macquarie sees this bank trading relatively cheaper than the other banks, because the ROA trajectory has been strong for the bank. So all in all, a positive view coming up from management as well as Macquarie on IndusInd Bank.
Right, thanks Gaurav. So we'll definitely be keeping an eye on IndusInd Bank. But moving on, let's switch focus to Motown then. How did automakers perform in February? Will they be in the fast lane or hit a speed bump? Srishti is joining in on what is being penciled in.
So for the month of February sales, we are expecting it to be a mixed bag, with all eyes will be on the two-wheeler segment as well as on the passenger vehicle segment, because segment-wise, we are expecting passenger vehicle segment to do fairly better in terms of the YOY sales data. But on a month-on-month basis, a slight moderation is what we are expecting. The demand is stable. There's no substantial recovery in the small car segment is what we are getting to understand, and the CNG is now getting to have some bit of a push in terms of the sales. If we talk about the numbers, then M&M, Tata Motors as well as Maruti Suzuki, they are all expected to experience a
10 to 11% of decline on a monthly sales data. If we talk about the two-wheeler segment, then we will have our eyes on the kind of a rural play these companies will come out with, because exports are expected to be stable. There's expected to be a push because of the marriage season as well. And if we compare the numbers on a month-on-month basis, no much change is expected there, but definitely on a YY basis, we are expecting Bajaj Auto as well as TVS Motor sales to jump by 17%. From Hero MotoCorp, we are expecting an uptick of 8%, while for Eicher Motors Royal Enfield, almost a flatter set of growth is what we are expecting. The commercial vehicle segment is could be a little bit of lagging behind, because the volumes are expected to decline due to the pre-election slowdown in terms of the orders. And similarly, on the sales data, we are not expecting much. Indeed, on a YOY basis, we are expecting to see a single-digit decline across the players. Tractors could be an interesting play as well, because from the reports we are getting to understand a mixed set of commentary, because a month-on-month sales is expected to rebound on a low base, but still the weakness persists in the rural markets. If we talk about M&M, we are expecting a 5% decline on a monthly sales data, while for Escorts, we are expecting a 12% jump. 6,925 units is what the company is expected to report. So all eyes on the auto sales data.
All right, thanks Srishti for that update, but let's take a look at what channel checks are saying for cement prices as well. Now, pan-India average retail price fell ₹7 per 50 kg bag month on month to ₹375 in February from the one that I mentioned in January. Now, when you look at region-wise distribution of cement prices, you have South India that saw the highest price cut of ₹13 per bag. And you had East that saw a price cut of ₹8 per bag. Now, when you look at North, West and Central, they witnessed a price cut of ₹6, 5 and 3 per bag. So, for the North, it will be ₹6 of a price cut, West ₹5 and Central ₹3. Now, price cuts, when you look at the reason for these price cuts coming in, right, it's just the lower than expected demand coupled with increased supply, as well as competitive pricing trends. So that's largely what the cement channel checks are indicating to us at this moment.
All right, with that, let's also take a look at all the important cues, all the important stocks that you need to be watching out for in today's trading session. And well, BHEL and Coal India, both of these counters will be in focus, because both of them have gone ahead and signed a joint venture agreement with Coal India to undertake coal to chemicals business by initially setting up a coal to 2000 TPD and an ammonium nitrate plant using BHEL's in-house developed PFBG technology. The next stock in focus is going to be JTEKT, and the company has evaluated and approved capacity expansion for their CVG segment, which is their constant velocity joint line. Another one in focus today is going to be IIFL Securities, because as a part of the internal restructuring, IIFL Management Services Limited, which is a wholly owned subsidiary of IIFL Securities Limited, has executed an agreement to sell its alternate investment fund business. Venus Pipes then will be raising funds to meet the capital expenditure requirements and to support the setting up of the company's first fittings plant and capacity expansion for seamless as well as welded pipes and tubes, and this is going to be set up at Gujarat. Let's also talk about KSB Industries. That will be in focus on the back of its numbers. Now, consolidated revenue has come in at 602 crore versus 524 crore, up almost 15% on a year-on-year basis. EBITDA too up 77% and quarterly and 4.2% on a year-on-year basis. And EBITDA margins have come in at 13.3% versus 14.7%, so slight pressure over there. And well, profitability, when we talk about profit after tax, that has come in at roughly 55 crore versus 56 crore, so rather flat when you look at it on a year-on-year basis. Lastly, let's also talk about what else will be in focus, and that is NTPC, because NTPC's Green Energy Limited has joined hands with Mahagenco for development of renewable energy parks in Maharashtra. So well, watch out for all of these stocks in today's trading session.
Absolutely, Snehi. And another stock that we'll be watching out for is definitely going to be Ashok Leyland on account of a management meet. Now, let's look at what Nuvama is saying about their management meet then. They're saying that more launches across power trains are lined up ahead for Ashok Leyland. And another key point that they're stating about the takeaways from the management meet is that they plan to invest ₹1,200 crore in Switch Mobility in financial year 24. And that is an important announcement coming in. They're also expecting cash flow to break even by financial year 25 end. So that's an important announcement on account of the cash flow. And now when you look at the MHCV growth, that is something that they see being positive despite headwinds. Now in terms of segments that they see doing well, they're looking at buses, tractor, trailers, as well as tippers doing well. So that's an important announcement coming in from the management meet as well. Largely, those are the views coming in when you look at what Nuvama is saying on Ashok Leyland's management meet. So Ashok Leyland will definitely be in the spotlight in today's trading session.
Well, yes, absolutely. Lots of stocks to watch out for on the back of their respective news flows. But I'm afraid with that, we're completely timed out on this edition of Market Cafe. We'll see you tomorrow at the same time at 7 in the morning. Thanks so much for watching. But as we bid you goodbye, you don't go anywhere because the market takes all the action ahead.